On today's podcast, we're excited to be joined by Bechara, Principal at Aussie Prospects, Australia's number one store in Aussie Home Loan Group and Aussie National Retail Store of the Year. With over a decade of experience in the industry and a diploma in finance and mortgage broking, Bechara is a multi-award winning finance broker who has helped countless clients achieve their dream of owning a home. As a member of the Mortgage and Finance Association Australia, or MFAA, Bechara and his team at Aussie Prospects are known for providing a world-class level of service that puts their clients at the centre of all their deals. In today's interview, we'll be discussing the home loan market in Australia, common mistakes people make when applying for a loan, and the importance of having a good credit score. Please welcome Bechara.
Welcome to the Passive with Property podcast, hosted by Dragan Domovsky. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
Welcome to the show, Bechara. Thanks for coming on.
Thank you very much for having me. Excited to be here.
Excellent. So, Bechara, can you tell our listeners who you are and what you do?
Yeah, I can. My name's Bechara. I'm one of the co-principals at Aussie Prospect, which is Aussie's number one store nationally, and I'm a finance broker. My job is to facilitate finance, whether it be residential or commercial, for clients who are buying property, houses, first home buyers, investors, commercial dwellings, things of that nature.
Fantastic. Bechara, can you tell us a bit about your background and how you became principal at Aussie Prospect?
Yeah, absolutely. So I've been in banking roughly about 15 years. I was studying finance at uni, and I left uni. So I was studying finance at uni, and I was wanting to get a part-time job, just obviously bringing some income. And I saw that one of the big banks was advertising. So I applied for a job and just started working at a bank, started as a teller. And through just a strange sequence of events where certain people resigned from their role, I was kind of lent towards lending and got into it kind of by accident. I didn't really have an interest in it to begin with. But when I got into it, I liked it, and then kind of spent a bit of time with that bank, then moved to a credit union, got a bit of experience there. And I thoroughly enjoyed being in business. And I had a business that I was running with my dad previous to that. So I liked being in business, but I really was enjoying finance. I was good at finance. I understood, I guess, the market and the credit space. And I thought I was pretty good with consumers and customers and clients. So I became a broker, which was, the ability to run my own business with a degree of freedom and also service clients and be more than just one bank, be more marketable, have access to more lenders, more policies. So I did that. I started that, should I say, in November 2012. And then I was just what they refer to as a store broker. So I just worked in a store, and I did that for about 5 years. And then that conversation came up about, my future and what I want to do. And I wanted, I guess, a seat at the table. As they say, I wanted a piece of the business. I wanted to own what I had helped build. And then I bought a share of Aussie Prospect. So there was initially 3 directors. So I bought an equal share. So we've each got a 25% holding. And that's how it became. Well, that's kind of a very quick overview of how I got to where I am.
Fantastic. And what was the business before that you were in?
Hospitality. So my dad was a chef by trade and would work, 12, 13, 14-hour days for somebody else. And, I had saved up a little bit of money that I was going to put towards my first home. But I thought, no, let's give this business thing a crack. I was 19 at the time. So I would work Monday to Friday, 9 to 5 at the bank I was at. And then I would work Wednesday, Thursday, Friday, Saturday, Sunday from 5 till 10 at the hospitality business that I own with my dad. And then Monday and Tuesday evenings I would do uni. And that was kind of my life, 19, 20, 21-ish. And then I became a broker when I was, I reckon, early 20s, mid-20s. But yeah, so that was that business.
So you don't mind a bit of hard work, do you?
I enjoy it. I work better when I'm with a degree of pressure, and I thoroughly enjoy hard work. I'm overly obsessed, and obsessed is probably the most accurate word, with getting from point A to point B as quickly as I can with as much efficiency and accuracy as humanly possible. So, just reviewing processes and scaling systems, changing things and working with different technology and apps and software and people and processes. That's the part of business that I thoroughly enjoy. I like to sit there and go, right, we've got a problem, for lack of a better word, or there's friction in how consumers are dealing with us or clients. How do we make that quicker?
Yeah, one of the formulas of a successful entrepreneur is obviously working hard, right?
Yeah, absolutely. I mean, I remember when I met my wife now, but girlfriend at the time, we were so limited to socialise because she was also working in a hospitality job, which she would work double shifts sometimes, morning and night. So we really didn't sort of see each other. But, obviously you make time where you can. But at the start, it was pretty difficult. You just run yourself into the ground. But it was, on my hand, I was building a business with my dad, helping him and my mum through to retirement, which was exciting. And on the other hand, I was building something for me, which was for the future, which was also very exciting. So it kind of ticked a few boxes for me.
Okay, awesome. So tell me, what makes Aussie Prospect stand out from other loan providers?
Yeah, really good question, Dragon. Brokers are sort of cut from the same cloth on a very small scale, in the sense that we can all access the same tools, we can all access the same lenders, same policies, etc. I think it's your knowledge of the market and your ability to understand what a bank is looking for in an ideal world, what the client is looking for, and then just piecing that together. The word broker is quite literally you're brokering the deal, brokering the transaction. So I guess our point of difference, and specifically to my process, but as a business, it's understand what the client wants. And that sounds so simple, but it is so understated. Because a lot of brokers, not just brokers, real estate agents, financial planners, lawyers, they're just sometimes so embedded in what needs to be done, they might overlook a few key points that the clients put in front of them. So actually understand, and to be blunt, stop talking, let them talk, find out what they want, write it down, build a plan, and then go back to them and go, here's what I've understood you're looking to do. So what makes us different is, I guess, our ability to listen to the client and then translate what they're saying into real life financial credit terms and as to what that means out there. And then finding a bank that's not going to give them just a good rate. There's so much more to a bank than just a rate. Are they interested in transactional banking? Do they have private banking? Are they a high net worth client? Do they need wealth advisory within that particular bank? Do they have commercial lending? There's so many different aspects. So finding a bank that fits, and then more importantly, finding a bank that will actually give them the money. Is the bank's appetite going to fit this client's situation? And not all banks lend to all people. There is a misconception that people sometimes will say, well, I've been working for 20 years. I've never missed a payment. How can I not get a loan? That's not what borrowing money is like today. So we've got a very strict process, policy and procedure. We're not perfect. We don't get it right 100% of the time, but we do endeavor to follow that unconditionally, non-negotiable, because we feel that delivers us results. Last year, the business settled $506 million in a year, which is an astounding number. We've got a good support staff of people here that help us, and we just stick to what we do best, which is understand the credit policy of that bank, deliver the outcome to the client, and outwork everybody else in the room. Do it quicker, do it more accurately, do it more efficiently. Loosely speaking, Dragon, the way you order an Uber is how business is the expectation of business, whether it's finance, whether it's Uber, whether it's hotels, whether it's checking into a plane. Consumers expect speed. So you have to be able to deliver speed. And that's something that we pride ourselves on.
Fantastic. Okay, Ken, obviously we've got a lot of listeners who are just about to possibly get into the market of investing or even just owning a home. Can you walk through the steps of the process of actually getting a home loan or an investment loan?
Yeah, absolutely. I mean, whether it's a home loan or an investment loan, the process is with 90% of the process is relatively the same. You would need to engage someone who's going to facilitate with finance. There's a lot of debate around, bank versus broker. I won't get into that because that's like probably a whole other podcast in itself. But I don't work against any bank. My job is to facilitate what my client wants, and if the bank happens to be able to facilitate that, then that's where we go. So, banks should work hand in hand with brokers because if they have the right products, it meets the client. So, at some point, you have to engage your financial specialist. Let's, for the purpose of this conversation, pretend you engage me as the broker. You would want to be speaking with them and having an open and honest conversation about where you're at financially, and to a degree, your personal life, children, no children, married, not married, planning a holiday, planning a wedding, etc. And you would want to then relay what you're looking for in the short term, 1 to 2 to 3 years, and then also the long term, the 4 to 5, 10 years, etc. You need to have that conversation, and then you would be providing some paperwork. Naturally, there is obviously an identification process, very straightforward, but then you would look at your pay slips or your tax return if you're self-employed, your bank accounts, your credit history, your conduct, your financial life. And the broker's job would be to determine, Dragon, based on your income, based on your expenses, based on your liabilities, here's some rough numbers that you can borrow. And then the second piece of that is your deposit. How does that equate to a purchase price? You could make all the money in the world as income. You still obviously have to have a deposit to complete the transaction. So what does that deposit look like as a dollar figure? How much do you need? What are you trying to spend? What are the true costs of the property, including stamp duty, council rate adjustment, should I say, registration and transfer? Is there a conveyancer involved, etc.? So working out how do we get from that initial query of I would like to buy my first home or I'd like to buy my eighth investment until the day you get keys, ideally. The broker's job is to understand and help facilitate that process for you. In some cases, it's a no, you can't afford to do this. But it's imperative to go, why can't we do this? And how do we fix this situation? What do we need to do moving forward? So that's where you would want to work hand in hand with your client. But if you're sitting there thinking, I need to buy my first home, what you think you earn and what you think you spend is unfortunately different to how the bank perceives your income at times and how the bank perceives your expenses. So I would engage a professional to help me understand what the banks are looking for and give me some numbers to work with. And don't be shy to shop that around. I have a lot of clients that go, do you mind if I Google what you've given me? Absolutely. I would hold my service to a high regard. So I'm happy for you to go do homework. And if you find something better or you find someone you prefer to work with, that's also fine.
Totally. So listeners out there and said, okay, well, I'm interested in purchasing something. I'm looking to get my first investment property. How much should I have as a deposit? So what does that look like as a percentage? So say, let's give, for example, 500,000. What should I have to begin?
So there's a general rule of thumb that when you're looking at buying property as a house to live in or an occupier, there's about 10 to 12% is a loose rule of thumb around how much deposit you should need. So 10 to 12% was generally the rule of thumb. There is some accuracy to that, but it really comes back down to personal circumstances. Again, you have to be able to meet the criteria and qualify for that particular loan. But if you're wanting to spend 500,000 as a house to live in, factor in costs and a few other miscellaneous buffers you'd want to build in, you'd want to have close to 70,000 to get you in the front door. That would cover things like stamp duty, conveyancing, for example. If there's a pest and building inspection, that's also something that can be, you would need to consider because you're obviously paying for that. There's so much more council rate adjustments, water rate adjustments, etc. I mean, I can give you a pretty spot on figure if you like for the listeners.
No, I mean, it's not important, but just a rough general idea, just so the listeners can actually understand.
I think like loosely speaking, 70 is a good number that should generally cover your costs and expenses and get you through the front door. If my memory is any good, your stamp duty should be probably 22,000 on that sort of purchase price.
That's right.
Yep. And then obviously there's the minimum requirements for the bank. But that's a figure based on 95% borrow, including lender's mortgage insurance. If you were to borrow 95 plus, it's a little bit less.
A little bit less. So I'm sure I've got listeners out there asking, what the hell is lender's mortgage insurance? Please.
Yeah. Lender's mortgage insurance is insurance the bank takes themselves. So they insure themselves for the money that you would borrow. But the cost is passed on to you as the borrower because you're the one borrowing the money. So the bank's effectively insuring themselves in that case. And lender's mortgage insurance is charged any time you borrow over 80%, whether it's an investment, a first home, whether you're refinancing. Anytime the loan exceeds the value of the home by 80%, mortgage insurance is charged.
Yeah. And I guess the listeners out there should, when they're taking this next step, should assess if that's something they want to do and take that approach, or, do the 20% deposit and move away from the lender's mortgage insurance, right?
Yeah, absolutely. I mean, if you can avoid lender's mortgage insurance and you have a sizable deposit, then that would be financially more appealing, because you're borrowing less money, you're paying less interest over the long term, because that insurance amount, whatever it might be, is charged to the loan. Yeah. And then it's part of your loan ongoing, which means you pay interest on it as well.
So in your experience, what are some of the common mistakes people make when applying for a home loan?
Yeah, that's a good one. In the day of social media and Facebook and Instagram and TikTok and everything, everybody's an expert in everything. And I'm guilty of that as well. I think I'll know something because I've seen it online. I'm like, oh, that's what I saw, so it has to be true. Yeah. So that's a really good question. Probably the most common one is that a couple of things. The minimum deposit I need has to be 20%. A lot of people, that's not correct. You can, if you meet lending criteria, etc., you can exceed 20 and 80% lend. So that's one I hear all the time. Probably another one, and this could be just from back 10, 20, whenever this policy existed. A lot of people think guarantors can help if you have too low of an income. So they'll say, for example, my parents will be guarantor if I can't borrow that. That's not the case. Servicing guarantors don't really, it's not a thing. They don't exist. The guarantor helps from a security standpoint and provides extra security to the application, which could in turn, without getting into the details, help you borrow more, but they're not supporting your income as a guarantor. So that's one that I do hear all the time. Probably the other one that comes to mind would be the people having, I'm going to be interest only, so that's going to help my case. I'm going to borrow more if I'm interest only because my repayments are less, and that's also incorrect. That's the bank doesn't go, well, if your repayments are interest only, Dragon, we'll never worry about the principal, because at some point you have to pay the debt back. So they're probably the three that I see all the time. Surely if I go interest only, I can increase my borrowing, and my dad will be guarantor, my mum will be guarantor, is the other one. And then obviously I need minimum 30% to get in the house, which is not true.
Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074. You're listening to the Passive with Property podcast, hosted by Dragan Domovsky. To ensure you don't miss out on valuable investing tips and information, subscribe today.
Okay. So the minimum requirement of an employer versus someone who's got an ABN working for themselves.
Very good. So the difference is one, paperwork. What you have to provide would probably be the first point of difference. If you work for somebody, you're generally providing things to the effect of 2 pay slips, 3 pay slips, depending. I guess I'll premise the answer first by it varies bank to bank and situation to situation. Like if you've been working as a clerical assistant for 35 years, you may find what you provide is different to someone who's been casual for 6 months, for example. But generally speaking, if you're PAYG, you're providing 2 pay slips. You may be providing an employment contract. If there's something unique or needs clarity with your income, you may be providing an employment letter. You may also be providing salary credits. So depending on your role, it could be a month, it could be 3 months, it could be 6 months worth of credits to your bank account. That's generally the PAYG requirements. Now, it's not always all in conjunction together. It's some of those pieces, but that's generally what you'll see. For self-employed, it's a little bit more involved. I'm self-employed, so getting money is sometimes painful, but that's where the broker has understanding of the policy works well. So for self-employed, you're generally providing your tax returns, so your personal and individual tax returns. Depending on how you run your business or entity, if you've got trusts, if you've got companies, partnerships, etc., that will vary what you're providing, but you're providing full financials. So your individual tax returns, your notice of assessments, your trust returns, your company returns if applicable. Again, maybe a letter from the accountant if there's something that has to be explained or cleared up. But you would be providing, and in those would obviously be your profit and loss statements, depreciation schedules, expenses, income, etc., etc.
And is there a minimum time between the employee or the person that's actually, have their own business? That's, for instance, I know back in the day, it's usually 3 months minimum for an employee, and it's usually 1 or 2 years for someone who owns a business.
Yeah, correct. If you're self-employed, you need to have an ABN registered, and the ABN has to be registered, generally speaking, for 2 years. So you need to have 2 years history. Some banks will accept 1 year's worth of your income, but they'll need to see sometimes 2 years. So they'll say, show us 2 years of your income, but we'll rest on this income or that income. Okay. Other banks will take an average of the 2 years of your income. Okay. Some banks will take the more recent year. Some banks will take the lower of the 2 years, but you're generally leaning towards 2 years of trading history. Whereas if you're PAYG, very subjective to the role, but if you're casual, most banks off the top of my head would have a minimum requirement of 6 months or 12 months in that role. Mm-hmm. It used to be lower. It used to be 3 months with some lenders, but of recent times it's become 6. Mm-hmm. If you're permanent, part-time or full-time, that could be less. Some banks accept the first pay cycle, so 1 week or 2 weeks. Some banks need you to be there for 3 months. Some banks want to see some consistency with your tenure. So have you jumped from completely different industries, or have you just simply changed pay points? So, for example, do you work for South Australian Health and you just go from different hospital to different hospital, or have you completely gone from being a butcher to a brain surgeon, as a silly example, for example? So
that'd be interesting.
Yeah,
I wouldn't want that brain surgeon.
No, that's right, absolutely. So there's a slight difference of them, but generally speaking, there's more flexibility with tenure if you're PAYG.
Okay. So let me ask you this question: Has the pandemic actually affected the home loan market in the industry recently?
Look, it has, but it's not all negative. As, like when the pandemic really kicked off, it changed drastically borrowing money, because all of a sudden people were sitting at home working. Yep. Now, for some people, nothing changed. So personally, I was able to work quite easily from home. My business didn't alter too much because I have that flexibility. Whereas some jobs you can't work from home. So if you're a receptionist at a hotel, and the hotel's closed for business, you can't be a receptionist from home for that particular business. So people were losing jobs, which is obviously terrible. And that does impact how much you can borrow. Because if you're house hunting or pre-approved or going through applications, all of a sudden now the bank has a duty of care, for lack of a better word, to say, well, what's going to happen to your income? Because you work at this airline company or you work at this hotel business, which are the most severely hit. So it did change it, absolutely. Income became more scrutinized. Policies were sharpened a little bit. And on one hand, it's kind of frustrating, and people would always say it's annoying the bank's doing what they're doing. But on the other hand, if you've got no employment or income, should you really be borrowing money? Is that the right thing for you to be doing? So it definitely did have an impact. And I saw heaps of a significant amount of policies change around what banks will and won't consider. And it was just, I guess, a reaction to the world we lived in. And to a degree, they didn't actually know what was happening either. So they would change their policies. Then another wave or another lockdown would come in. Yeah. And then they'd go, wow, we have to now adapt to this. So it did absolutely change it,
Yeah. Okay. So let me ask you this question. How do you assure your clients are getting the best interest rates and the best terms for the
loan? It really comes back to what they want. And I probably wouldn't use words like the best loans or the best terms because, to be really, grim, it's a debt for 30 years, right? So the word, and a lot of people say, I guarantee the best rate. Well, the best rate is 0%. So I would choose my words with my clients because I want to say to them, here's, I guess, what you've advised me you need. So have I understood your objectives? And let's assume the answer is yes, you have understood it. Then I'll go find them a bank that fits. Then I'll come back and pair what they wanted with what the bank can offer. to explain or justify why I've teed up with that particular lender. And then I'll present them with generally 3, 4, sometimes 5 options, depending on what's necessary.
Mm-hmm.
They will always then pick. And I'm very transparent to say this doesn't mean that this bank and this product is the best thing in the whole world and there's nothing better than it.
Yep.
But this fits your needs, which you've confirmed for me, and I've gone back and confirmed with yourself and the lender. This ticks the boxes. And ideally, once we've got those boxes ticked, we want to find a competitive bank and a competitive interest rate. But if you want a bank that'll consider alternate lending, for instance,
yep,
generally they're not going to be very competitive on price. So, or interest rate for that, for lack of a better term.
Yep, yep.
So the interest rate does play a part, but it's not the be all and end all. But it is, you tell me everything you want, Mr. Klein, and then I'll come back into you and I'll tick every one of these if I can. So how do I know that they've got what they're after? Because they've told me exactly what they want and I've gone and sourced it. If it doesn't exist, obviously that's a little bit different. Mm-hmm. But generally speaking, here are 10 things that we want in a bank, non-negotiable, and I've gone and got them for you.
Okay.
So they're telling me what they want is probably the way I would vet that they've got what they want.
Understood. Okay. Bechara, true or false? Can clients negotiate interest rates? Explain a little on that.
Yeah. You can negotiate your interest rate. You can contact your bank. You can email your bank. You can do it on your net bank. And you can negotiate your interest rate, ask for better terms in the current climate, in the current market. Mm-hmm. How that negotiation goes, whether it yields any result, obviously is very subjective to your situation, the loan, where you're at, and the bank. Mm-hmm. And you can absolutely negotiate. And I would be saying, not just your loan, insurances and Foxtel and everything that you can, I would negotiate it every 12 months, every renewal, whenever it might be, because the cost of living is going up. And money's always been important, but it might be now more important than ever than it ever was. So I would say, you can negotiate it, but how well of a negotiation you do is probably the point of difference, because you don't know what 35 banks, 10 banks or 15 banks are doing. And that bank you're negotiating with is more than likely not going to tell you what their competitors are doing. Mm-hmm. So you can negotiate, yes, absolutely. And any bank that says you can't, the bank can refuse to give you a rate, but that doesn't mean you can't have the conversation.
Yeah, they can always move to the next bank, to the next lender.
Spot on. Yep.
That's right.
Correct.
There's a little tip out there for the listeners who actually have a loan and are worried with the interest rate rises, negotiate.
Absolutely. As long as you're comparing like for like. Yeah. Because banks know what other banks are doing. So what you don't want to be doing is saying, give me this rate because bank A has got a better rate. Yeah. But technically you wouldn't actually be able to go to bank A and borrow money because you don't fit their policy. Well, then that rate becomes entirely irrelevant.
Okay. So what advice would you give to someone who is looking to buy their first home or first investment property?
So look at where you're at financially in your life. Yep. Obviously, generally speaking, a lot of people have a good idea of their earnings, their incomes, their expenses. Yep. And ask yourself, do you have free cash flow? Do you have residual income? Do you have disposable income, whatever you want to call it, at the end of every week, fortnight, month, etc.? And are you saving? Are you able to demonstrate you're creditworthy, to use a bank term? Yep. And if you are living paycheck to paycheck, you don't have any money saved, and you don't have the ability to demonstrate you've got good savings patterns to get to your 10 or 20% deposit, the bank's going to obviously be able to see that as well. So it's going to be very difficult. So the first thing I would do is assess your income and what are you earning? Create a budget, a savings budget, a spending budget. Know what's coming into the household. Very important when that's done. A lot of people will look at today's spending, Dragon, and go, I make, for argument's sake, $1 a week, and here are all my expenses. And they write down their expenses, I guess, in future tense. But generally, if you're looking backwards at your expenses, they'll probably be very different to what you think your expenses actually are. Because by human nature, we spend probably more than we should. Yeah. And money comes and goes a little bit freer in today's world. So don't sit there and create a budget based on what you think you're going to spend. Mm-hmm. Go back 90 days in your actual expenses. That'll give you a true representation of what you spent. Then I would look at that and go, wow, I have spent whatever, $1,000 on coffee this month. Is that a necessity? Could I have saved that money? Mm-hmm. So create a budget, know what you're earning, look at your expenses. Yep. Then I would also look at your savings, see where it's at. 5 or 10,000 probably is not going to get, it won't get you a property. So look at how much your savings are. Do a bit of market research on where you're looking to buy, what suburbs. if you're wanting to spend 400, but the suburbs of shopping are selling for 900, well, then you have to realign, I guess, your expectations.
Mm-hmm.
But once you have a little bit of an overview, I would engage a professional immediately, because when I sit with my clients and go, what are you earning? What are your expenses? If they don't have those expenses clear, I'll say, go back and let's do it. Let's have a look at it. Let's see what you're earning and where your money is spending, because you should be able to save at this rate. So financially, get yourself as well prepared as you can, because you're going to have questions that you have to give to the bank or the broker. And then I would speak to a professional, run through your situation, find out where you're at. And it doesn't have to be a meeting that determines, yes, you can buy a house, or no, you can't. It might be a very rough consult to say, we're thinking of getting to the property market. What do we have to hypothetically earn? What are our savings? What do we need to do to get there? Where are we at today? And how close is that objective? The answer might be surprisingly, hey, you're closer than you thought. The answer might be, no, Dragon, you're not buying a house for 2 years. But the good news is, here's what you need to do to fix that, and we can make that happen quicker.
Awesome. Okay, Bechara, you have clients, I'm sure, that do come to you, and for the sake of the listeners as well, they'll probably want to know, I've got 40K in my bank account or 50K in my bank account. My parents are willing to give me another 40 to make up for that. Is that possible?
It can be, absolutely. So gifted funds can be used towards a purchase. There's a policy which I would say all banks have. Is called genuine savings. So what that policy means is that 5% of your purchase price, so if you're buying a house for $400,000, that's $20,000, 5% of that has to be genuinely saved in your own terms. So that's money that you've saved over a period of time, no less than 90 days, 3 months. It could be 10 years, but it has been saved. It can't be money you've come from sale of furniture or a sale of a car or anything of that nature. And it's going to be a savings pattern. The bank likes to see that savings pattern. If you've met that 5% genuine savings, then the difference, hypothetically, in this case, 40,000, that can be gifted. Mum and dad would sign a gift form to declare where the money's coming from, and then the gift would be transferred to the client's bank account, which will be submitted with the application to show, here's my client savings, they've got 5%, here's a gift from mum and dad in the account, here's a letter from mum and dad showing they've gifted the money, and that generally should meet policy as well.
Awesome. So, okay, another example is me and my partner have a house of 500,000. We've paid off, 200,000. We've got 200,000 of equity there. How can I use that equity? What sort of deposit would that look like through the equity?
Yeah, good question. So I would get the house valued straight away. Find out what the bank thinks it's worth. Very different to what your real estate thinks, the agent thinks it's worth, and different to what your council rates think the property is worth. So I would get it valued, see what it's worth, and then once you look to use that equity, you are increasing your debt, which means your servicing or the servicing of that loan and future loans may become tighter if your debt position's increased. So it's not as simple as saying, my house is worth 500, I've got a loan of 300, give me 200. Because you have to service the increase. However, if you have a larger deposit, it should decrease the loan you get for the next house. So you might find a slight balance there. The other thing is the banks do not let you take every dollar of equity available. They will retain at a minimum 10 to 12% of equity. So generally when you're refinancing and cashing out, most lenders will sit at a maximum lend of 88% to allow for insurances, which takes you to a total of about 90%. So the bank will always retain some equity for protection for downturn in the market. But if you've got a strong enough income and you've got equity available, we can draw upon that equity, use that as a deposit to buy the second investment property. But you are obviously increasing your overall position.
Okay, fantastic. So how is it, tell us a little bit about credit score. So how important is it for a client to have a good credit score if they're applying for a loan?
Yep, it's imperative. And this comes into the financial health. Having a good credit score, a good credit rating, and good financial conduct is very important. Because if you say, hypothetically, Dragon, lend me $100. And then you said to me, I'll lend you $100. Can I have some support and history that you've actually paid back the previous 100 you lent from someone else? And I go, no, I haven't paid that back. You're less likely to want to lend me that money. And the same applies with a bank. If you're applying for a loan of $400,000, $500,000, but you've got history demonstrating you have not paid back your other debts, that's naturally going to be a red flag. And that doesn't have to be, a roadblock, be all and end all. There's, ways to improve your credit score. But you want to keep up to date with your creditors and your debtors. You want to pay your bills and all that sort of stuff on time, because you don't want your credit history damaged with unpaid debts or defaults or anything of that nature, missed repayments on credit cards, car loans, because the banks, not all banks, should I say, and credit reporting agencies have something called comprehensive credit reporting.
Mm-hmm.
So that's a very detailed analysis of what payments you've made, what payments you've missed, etc. So if you have a really bad score, it could limit the lenders you can go to, or if it's really bad, it could mean you don't borrow money at all.
Yeah, and where can listeners actually check their credit score if need be?
There's so many different credit reporting agencies you can go to. I don't have one in mind in terms of a preferred one, but I would just avoid what might seem like a scam or a dodgy sort of thing. Go to a reputable business, reputable company. I would do some Googling, some researching, but there'd be a fair few out there that you can get your reports. But the other thing is that they all report quite differently as well. So I would be, if you have a broker, they might be able to assist with helping you with that as well. They can do a credit report for you. But avoid the $1 credit score and just a company you've never heard for, because not to say that they're not legitimate, but maybe in that case because you want accuracy and reliability, and it's going to show quite an extensive set of personal circumstances. I'd stick to someone who's maybe known to me. Okay,
Bechara, any sort of last words you want to tell our listeners out there?
I mean, be informed, be educated. Not that other professionals give you the wrong information on purpose, but if you get something that you feel doesn't quite sit well, then I would investigate. I would do some research, query it, find it out. A broker should be able to give you information you can't Google in terms of bank policy, credits, and credit scenarios, and what you can and can't do. But be informed. There's nothing wrong with being the most informed person about your situation. So do your homework, and if change needs to be made, make a plan, execute it, stick to it, and have regular touch points to measure where you're tracking.
Excellent. This is what we always say here in this podcast: educate, educate, educate. Nothing wrong with that, right?
Yeah, absolutely. Even if you're house hunting, and you've got a suburb in mind, become the most knowledgeable person on that suburb. What house sold for when and at what price point. Not to take business away from you, but be informed, because that helps you with your position. My neighbour's auctioning his house next week. I'm going to the auction. I have no interest in buying the house, but I just want to know what happens at that auction, because it's an area I live in, so I've got an interest in.
Yep, definitely. Thank you, Bechara. Now, where can people find you if they want to get in touch?
Probably phone's easiest. I spend my days not doing podcasts, but I spend my days in meetings and client appointments. So emails I don't check as often, but my phone 0404 209620. Give me a call. And if I'm in an appointment or doing bath time with my little boy, I'll call you back as soon as I finish. But phone's probably the preferred method. But yeah, if you Google me, my name is unique, so you won't find many people out there, and you'll get all my contact details from there. Yeah,
I'll add a link under the description and all the necessary contact information and links to your website. Fantastic.
Appreciate it.
Bechara, thank you very much for your time. I hope I get you on again in the near future, and thanks for coming on.
I appreciate you having me. Thank you so much, and I definitely look forward to speaking again.
Thanks for listening to the Passive with Property podcast, hosted by Dragan Domovsky. For valuable information on property investment and wealth creation for both first-time and seasoned investors, be sure to subscribe today. The Passive with Property podcast is brought to you by the Buyers Agency Australia. Are you stressed out not knowing where to find distressed, off-market, high cash flow properties in high-growth areas? What about the best strategy to build a wealth-generating portfolio? Look no further. Dragan Domovsky can help. With 20 years of experience as a property investor, Dragan is a qualified property investment advisor and expert buyer's agent, so he knows how to find the best deals and negotiate for his clients. And right now, he's offering a free 45-minute strategy session to get you started, normally worth $500. Text the code PWP along with your name and email address to 0405 105 074 now to take advantage of this offer. Don't wait. Take control of your financial future today. That number again, 0405 105 074.